Okay, so the next thing we want to go into is this idea of what a tax planning philosophy. I do think this is a little unique here to us at Vance Wealth of really embracing this idea of, well, what does it mean to have a tax planning philosophy? Because the reality is, if we are a high earner, we're building assets, our net worth is increasing over time, and that might be through your W-2 wages, it could be through owning a business, it could be through just being a great investor. The reality is you're going to pay tax, and that's part of the deal. And while we recognize you're going to pay tax, we need to be smart about paying tax. And so part of our philosophy starts here. So I listed these 3 bullets out here because this is really what we live by. This is the planning that we try to help our clients with, is focus on your lifetime tax liability. Now, we don't know what the future is going to hold for everyone, but when we build a financial plan, let's say a 30-year financial plan, we have a sense of what cash flow is going to look like for a client, what their income is going to look like for a client, more importantly, what their taxable income is going to look like for a client. So if we can make good decisions to basically good decisions with the idea of focusing on how do we limit our tax liability over our lifetime. And this would be different than the idea of how do I save taxes today in this current year. So we love the approach around focusing on your lifetime, not in any one given tax year. I think that makes us unique. The next bullet point there is attempt to smooth out income volatility, right? So the reality is sometimes people have variable income. And, so that means sometimes they're on a higher tax rate, a lower tax rate. And we find that it's one of the best things we can do is if we can smooth that out, albeit maybe at a higher rate, but if we can smooth that out, that will help us manage some of the ongoing tax planning. And then embrace paying taxes at lower rates. So that's one of the things that we recognize at some of the lower end. There's a 10% bracket, a 12% bracket, a 22 and a 24. We consider those low rates on a historical basis. And so we do embrace the idea of, you know what, sometimes it's just better to pay tax than to defer the tax, because that's where like retirement funding and a lot of different vehicles, they don't avoid the tax, they defer it. And so sometimes it's just better, let's just pay the taxes now at these lower rates. And a couple ways that we utilize or that we take advantage of this is consider using Roth IRA or 401k accounts, and then also consider partial Roth conversions. And we'll get into that a little bit more as we go deeper into our conversation today. So the tax challenge. So when you look at this, there's really these 3 buckets. Tax me now, tax me later, don't tax me again, right? This idea that, okay, we know tax me now is, mutual funds, CDs or money market accounts, real estate, right? When you're getting income off of those, you pay tax today. Tax me later are the vehicles that you put pre-tax money in, so you get a deduction, and things like traditional 401k, IRAs, SEP IRAs, 403bs, 457, these types of retirement plans, these are tax me later, right? You put the money in, you get a tax deferral, the money grows tax deferred, and when you take it out, you pay tax. Again, tax me later. And then don't tax me again are different vehicles around life insurance, municipal bonds, bond funds, Roth IRAs, and Roth 401ks. One of the things that you notice on here, there's a bunch of disclosures, number 4, 5, and 6, which is, I know, a little bit hard to read. But the don't tax me again, sometimes we'll call those tax-free, but there are some caveats. So it's not always as clean as these are completely tax-free, because they're not. But for the most part, they have this don't tax me again structure. And the reason why I kind of highlighted here and had a picture of the White House is you look at, well, these vehicles here, tax me now, tax me later. This is how government gets some of the funding from a retirement perspective. So when we recognize that there's a tax challenge, right? We've always talked about with clients like building your different buckets of wealth with different types of accounts, right? So those 3, if I just go back, those are 3 different buckets that most people should have, right? You're going to have the taxable accounts, the pre-tax accounts, and the Roth accounts. And the reason why that's relevant is as you start getting older and closer into retirement, which I would define kind of this window of age 55 to 75, is that really becomes an ideal planning window. I can't tell you how often people will come into our office for the first time right around this age of 50, 55, and we get excited because we know we're going to be able to make a really good impact from a tax perspective, because there's so much planning that's available that's, somewhat complicated. It takes a decent amount of planning and understanding all the code, but this really is the best window. So, and the reason for that is you're prior to your RMD requirements. So, when you have to take money out of your retirement account during this window, this is basically pre RMD requirements prior to maximum Social Security age, right? So we know you're not eligible for Social Security till 62. Full retirement right now is age 67, but you can also wait to age 70. So prior to the Social Security age, you have this window where you could force money out of your accounts and not exacerbate tax liability when it comes to taxation on Social Security. And then the third part of this is if retired, you're likely in a lower tax bracket. So if you had this entire working career where you were in a higher bracket and you deferred money into a retirement account, now that you're in retirement, it could make sense to start converting, doing different things, because if you're in a lower tax bracket, you might be able to move the money at a lower rate. So again, this is really the ideal planning opportunity. And again, I think it's not an accident of why people find Vance Wealth around this time. I would tell you the majority of people are coming in our office kind of 50 to 55, empty nesters, really looking for some guidance on, okay, I don't want to work forever. How do I actually put together a strategy for my financial plan, but also how do I pair in a good tax planning strategy as well?